So where we are today, the stocks have, I'd say, fair value. Some would say expensive. Depends on where you are. The market is really a combination of a lot of different areas, but we may continue to see things move up from here, but it's going to be at a much slower pace. So let me just, we like to always have an understanding of what's driving the market. Certainly the Fed, support from the Fed was huge, but during the lockdown last year, most people that were working, a lot of people lost their job, but those that were working were saving money because they couldn't go anywhere. And there was a huge amount of savings. On the other hand, that paid down debt, which is also very, very positive. We had the first stimulus that came out. Now we've had another stimulus that has been passed that is supporting things as well. Not even all of that has gone into the market yet. There is talk of an infrastructure bill. We will get an infrastructure bill. We just don't know the size of it. Certainly we need roads and bridges, and all of that would be very important for us to update. Companies are buying back stock now because in most cases, they've been very profitable. And the quarter that we're in right now, which is the second quarter that ends in June, will be huge when we report earnings for this quarter compared to the quarter last year. No surprise there. Everybody knows that we were shut down, a forced shutdown last year. So housing, a lot of the economy, a lot of the housing is caused by change in what people are doing and where they want to live. That's a good thing. There's so many people that are employed by housing or areas in housing. Then people's homes have gone up in value, so you have a wealth effect there. There are shortages, as we know, that have to do with housing, and that some of that will get worked out. So we think as we go through this year, the economy will continue to strengthen and into next year. So how does that play out in the stock market? I think we've plateaued here for a little bit. It should be higher next year, but we're in a stage now where the averages are kind of going sideways, but areas within the market are changing dramatically. We call it a rotation in leadership. In the market, the Amazons and Apples of the world are no longer the ones that are driving everything. So it's going to be erratic from here. The summer, I'd be fine with the balances that we have today at the end of the summer. I mean, that sounds strange, but we need for earnings to continue to pick up and support the valuation that we have in stocks right now. So the market is really digesting the move that we had last year. Could we have a pullback from here? Yes. That wouldn't necessarily be bad, 5%, 7%. Keep in mind, there's still a huge amount of cash on the sidelines that people want to get in. They were cautious. They didn't get in. So we don't see a bubble. You see write-ups about a bubble. We don't see that. I think the market will be higher at the end of the year and as we get into next year. Things that concern us, we're always looking over the horizon, rise in interest rates, that if the economy gets overheated, then the Fed may be forced to raise interest rates. Stock market doesn't like that. It's the direction and pace that makes a difference there. There's also concern of taxes, pretty steep potential increase in corporate taxes. What does that do? We'll see how all that plays out. So the news has been all in all pretty positive over the last year. We're cautious in here, but we like what we see over the next couple of years. Any questions on that?
I have one.
Surely.
Are we concerned about inflation, and how are we built in to handle that?
Yeah, inflation is, yes, we are concerned about inflation. The stock market in general is concerned about inflation. We have in our fixed income area, and it'll show you this, as interest rates go up, that has a negative effect on bonds that you own. So we have active management in all of our bonds, meaning that managers, they know what's going on as well, and they are in a better position to figure out where they need to be along the yield.
Jack, you're muted.
Lost you, Jack.
Jack. Lost you, Jack. You're muted.
You may not be able to hear us, I don't think.
He can't. Jack, you're muted.
He's
He
on a
said
roll, man.
last time that his computer was going off spontaneously.
Sorry, how much did you miss of that?
A little bit.
Okay, my computer tends to, it just goes on mute all by itself. So sorry. Would you put up the change in value? I want to,
Sure.
Okay, so change in value. This isn't performance. This is just looking at our managers from March 31. That's where our quarterly report would be. And then May 25th here. And the first part is all equities. I want to show you our equities. If you look at the subtotal, 323 million at the end of March, 338 now, up 15 million in, hey, we're talking just a few weeks here. That's almost 5%. That's a big number. I mean, the assets in here, whether you're going up or going down, it's big numbers. On the right-hand side, I want to point out nuance. What is starting to change here a little bit, our small and mid-cap stocks, Systematic, you see up 188, Alger, Weatherby, which is a new manager for us, they're up less than the large caps, but after the election last year, the small and mid-cap stocks exploded, just exploded. So November, December, they did, January, February, they did very well. They're not doing anything wrong. It's just rotation back into, to a certain extent, growth. Douglas Lane, our largest managers, see there 43 million, up 6.65 for just in the last few weeks. WCM in the international area doing very well too. So big move in stocks over the last few weeks. Look at the fixed income, Lisa, if you would raise that just a little bit. And to answer the question about fixed income, you see in March we had 142 million, and now we're up a little bit more, 142.9, up 700,000. That period of time, that's 0.53%. But looking at the managers, you see some negatives in. So it really depends. It depends on what assets you hold, and again, where you are on the yield curve. It's much harder to make money in bonds when interest rates are going up and when we anticipate or have the risk of inflation. So we're seeing some of that. I point out that Wells Capital at 0.42 is a pretty good number. Percent change in Federated up 1%. So we're not anticipating a lot of return from our 143 million in fixed income over the rest of the year. Frankly, it's going to take a couple of years, we think, for rates to normalize, whatever that means, move higher in the next 2 years. And then we have a good mix in managers. And we're constantly in contact with them, and think they have a good plan for changing rates and changing inflation. Any other questions on that? Okay, very quickly, I'll look at performance, and I'm not going to go through all the managers here. So yes, so here again, this is the combined total. Again, this was as of the end of March, 474 million for the quarter, up 4.19% ahead of our benchmark. For the fiscal year is for the city is June. So this is from July 1 of last year through March of this year, would be 3/4 months. We're slightly ahead of the fiscal year to date. On a 1 year, a tad behind there. But look at the return, the compounding return over the last year. Let's call it 39%. That's a big, big number from March of last year. 3-year total, 10.19. 5-year total, 11%. At 11% on the asset base we have, the city's money, or all of the pension money is compounding very strongly, and we are doing this in the mix that we have in less risk than we have in the markets. On the equity side, right under that, a tad behind for the quarter, still right at 7%. For the fiscal year, 33%. And for the 1 year, this is not a 60% change. But again, that started in April 1 of last year's, and that's what stocks have done over that period of time. On a 3-year basis, up 14. I'd point out that our stocks have been outperforming the benchmark on a 3-year basis, on a 5-year basis, on a 7-year basis, and right on inception, just right in line. So we're very pleased with what's happened in the equity part. In the fixed income, the total part of this first quarter, you do see a slight decline. That's the increase in interest rates over that first quarter, and they're just slightly behind. On a fiscal basis, we're ahead 3.4 compared to the benchmark. On a 1-year basis, bonds were up 7.18. We're not going to see that number again. It's just 7% in bonds is not achievable with rates going up. So that helped our compound growth rate. Longer term, you see bonds have been up 3 or 4%. Let's turn one more page there and just Piedmont, one of our managers in Durham had been behind. They're starting to catch up a little bit. Their 3-year number is 2% behind. We think they will continue to catch up. Douglas Lane, our largest manager, we actually took some money away from them, not because they had done poorly, but because we want to rebalance and make sure we don't have a horse that gets too far size-wise ahead of everybody else. 62% compared to 56 for the index, the S&P 500. So they outperformed over the last year by 6%. They're ahead on 3 years, 5 years, and 10 years. Done very well. You can see the S&P 500, just an unmanaged index, come down. Nuance behind, pretty conservative manager. Last year was a weird year. If you look at that 1 year and you say, what's wrong there? Up 36% in the index. What really bounced last year in the mid cap area was the low quality stocks that had been very, very low. They don't have any of those. So on the inception to date, they look a lot closer. They will catch up. Earnest Partners, I guess that's the highest thing that we show, other than, well, up 74% the last year. I've never seen numbers like this. So again, look very, very strong and have outperformed 3, 5, 7, inception to date, done very, very well. Alger, we put about 22 million with them, just starting to do their thing. Systematic, 30 million with them, up 87% over the last 12 months. A lot of community bank stocks and things in there. Look at bonds very quickly. Garcia Hamilton is more of a treasury manager. We did take some money away from them. They had kind of a miscall in what was taking place. So they've done a good job over a long period of time. Their 3-year number has hurt them and hurt us. That 149 compared to 280 hurt our fixed income number. And it's again where they are on the yield curve. That there are no bonds that didn't pay off. It's just where their assumption of where to be on the yield curve was not accurate. Wells Capital, right under, good job. Our convertible bonds, and we have this in 2 places because we don't have high risk bonds anywhere in this portfolio. Convertibles, really a hybrid. You'll see we're up 63% over the last year. That's a catch up in value. Federated did very, very well. The 4.79 compared to 71 for the index. Their active management did extremely well. They have 2 Federated conservative, have another portfolio. Then Advent, CWS Advent, up 4, let's call it 38%. So those 2 areas really helped us in our bonds. Then Bellhaven, another manager that we put in place over the last 3 years, 4 years, up 429 over the last year compared to the index at 0.71. So the active management that we had in bonds really helped us a lot over the last year, and we're proud of what they've been able to do to support things. I'm going to stop right there. Just hopefully have given you a flavor for what we're doing. I think we're on top of everything. It looks pretty rosy when you look in the rearview mirror. Going forward, it's going to be a lot more difficult for, I'd say, for all managers, fixed income and equities. But still, we think things will be higher for stocks at the end of the year. Questions on anything? Okay, we appreciate your time.
Thank you, Jack.
Thanks, Tom.
Thank you. And Lisa, do we still have Mr. Alex Brown? Is he speaking today?
No, Alex Brown's the company.
That's the company. Jack is with the company. Yeah.
It's all right.
That is hilarious.
That's
Where's
fine.
Alex? I don't see him. Thank you, Jack.
Okay.
Any other business for the regular session? And now, do we still have this actuarial presentation?
Greg Stump is on the call. He's next.
Okay.
Okay.
Mr. Stump, thank you.
Good morning, everybody. I have been having some periodic microphone issues, so hopefully it'll be okay and everybody will be able to hear me. I assume I'm coming in okay so far.
Good.
I'm going to share my screen. I have a presentation for you that it's the one we do every year. So this is the annual update, and you should be able to see my screen now.
Yes. Yes.
Okay, I got it on full screen, so as big as it can get. So we're just going to go over the valuations for WSPORS and for the separation allowance plan, and look at what's happened in the past year, and look at the most important thing, I think, is the future funding outlook, which we'll get to at the end. So here are the valuation results, just kind of a snapshot of both plans and looking at all different factors here. As you know, the WSPORS plan is closed to new entrants. They're going in the state plan. So what we have is a decreasing population. So it's 805 people total in the plan, all different statuses, which is down a little bit from the year before. 39% of the plan is active employees, which is down from 42%. Of course, eventually that will go to zero. Separation plan, 623 total, 80% are active, and that's stable. That's kind of stays stable year to year, because once people turn 62, they're out of the plan altogether. The benefit stops. And that's good. You know, having a younger plan helps. So in the future, this continued higher proportion of inactive eventually will be 100%. I have a graph that's going to show that. And for the separation allowance, the profile is likely to remain pretty stable going forward. Funding progress, 81% with smoothing, 90% without for WSPORS. So that's a function of the 7-year asset smoothing, which means that you had a great year in 2020 and so far in 2021, we just heard Jack talk about that. But you only recognize a piece of that. This is smoothed over 7 years, and that's been in place for quite some time. But if you take all the smoothing away and say, let's just fully recognize everything that happened in 2020, then the plan's 90% funded. So that's really good news. Unfunded liability is 41 million. So that's similar to last year. By the way, we are doing a full assumption review next year where we look at, projections and salaries, when people will retire, which ages, how long they live, things like that, the return assumption. And one thing we'll also look at there is the 7-year smoothing. So we'll do some different modeling and say, is this still what the board wants to go with? Do you want to change to 5-year smoothing, which is very, very common, et cetera. So that's coming next year. Separation plan is 42% funded with smoothing, 46% without, and an unfunded liability of 16 million. So that seems bad, side by side with the larger plan. But I have to remind you that, this is a requirement for the state. And most of the other plans out there, the separation plans, they don't have any funds set aside. So they're at 0% and you're at 42. So that it's good when you look at it in that perspective. In the future, this is expected to improve significantly over the next 5 or 6 years. Of course, it always depends on what's going to happen in those years, especially with the investments. And the separation plan is expected to improve to 60% within 5 years and 80% within 12 years. And you will see those when I show you the projections at the end of this. And if anybody has questions along the way, just please interrupt me. You don't have to wait till the end. Contributions currently $6 million a year about for WSPORS and about 2.5 for the separation plan. Most of that is going towards the unfunded liability. So remember, there's 2 pieces to the contribution. There's the benefit accruals. So everyone who's actively employed, there's an amount associated with that. And then there's trying to close the gap between 81% and 100%, or in this case, between 42% and 100%. So that ends up being a big part of the contribution, and you can see how that's going to change when we get to the projections. Contributions in the future, the normal cost is decreasing for WSPORS because it's a closed plan. So as people retire and they're not replaced with new officers in the plan, that normal cost is going to go down. The amortization is decreasing because we have some investment gains that are going to be realized over the next 6 years. For the separation plan, it's going to increase steadily until the funding improves. But as a percentage of pay, it may actually decrease. And again, we'll look at all these things. So snapshot, there was a full report that goes along with these. You know, there's one report for WSPORS, there's one report for the separation allowance. So this is just kind of a summary version, just a snapshot of here's all the key results. So looking at the 1 year change, what we want is the assets to keep up with the liability or even surpass it, you know, on a year-to-year basis, and then especially over the long term. The liability increases year to year. That's normal. It's not a sign of anything, you know, that's going wrong. It's just the normal function of a plan. So we have a $10 million increase in the liability, 2020 to 2021. Remember, the valuation date is as of 1/1. And the assets are up by 19 million. So that's good. The assets are growing faster than the liability, at least for that 1 year. But with the smoothing, we're only recognizing a piece of that gain. And so that's up about 9 million. So 10 versus 9, almost the same. The market funding ratio went from 85% to 90%. That's good. The smooth value ratio went up a tiny bit. On the unfunded liability, about the same. You know, it's a $10 million increase here versus 9 in the assets, so it's a $1 million increase. So when you see that, you're going to have a contribution that's about the same. And I know that's a little disappointing because coming off a good year, but you'll see how it's going to improve going forward. So the actuarial contribution, a little bit over 6 million last year, a little bit over 6 million this year, slight increase, 180,000. Percentage of payroll, it's going to increase over time. And the percentage of payroll is becoming less and less relevant because this is a closed plan. So, you know, at some point that's going to be over 100% of payroll, and that really doesn't mean anything anymore because the payroll of the folks in the plan is decreasing. The separation allowance, same kind of picture here. You know, we had a $1.8 million increase in the liability, 1.4 in the assets. It's not quite the same as the WSPORS plan because the level of assets is just lower. So we do have an increase in funding, 2% on each basis, and the unfunded liability, there's an increase there because of the difference here. And so you do see an increase in the city contribution. That's up 200,000, a little bit more than that. But as a percentage of pay, it's up only 0.4%. So there's not a lot of change, you know, just valuation results 1 year to the next. It's almost the same picture year over year. But where you're going to see the difference is in the projected costs. So, you know, what's changed? Well, the funding is still near 80% and for the one plan and 40% for the other. So again, about the same. There's been a higher return than expected the last 2 years, and that leaves us with 19 million in unrecognized gains and 1.3 million for the separation allowance. So what that means is we get to recognize that 19 million over the next 6 years, and that's going to help. It's going to improve the funding and it's going to decrease the cost. And, you know, as always, it depends on what happens in those years, but that's a really good position to be in. Non-investment experience, meaning retirements, mortality, pay increases that happened different from what we expected. So we have assumptions for all these things. There are tables of, you know, a certain percentage of people retire at, you know, age 58, age 59, age 60, et cetera. Pay increases differ over the course of people's careers. And so every year we look at it and say, okay, what happened differently than what we thought would happen? And what happened was there was an experience loss, meaning what happened was less favorable than what we thought. And if we try to pinpoint what that was exactly, there was higher pay in 2020. And I know this is, you know, mostly pandemic related. So this could be a blip, you know, this could be something that it, you know, reverses itself going forward. However, to the extent that people have the higher pay included in their final average and subsequently their benefit, that's experience loss is going to stay. What we do next year with the experience study is we look at all these things, taking into account that 2020 was a little bit different, and say, you know, do we need to adjust these? Or is there a general trend of, say, people retiring earlier, or people living longer, et cetera? Here's a picture of that unrecognized asset value. here's the 19 million that I talked about, this unrecognized portion. The red bar here is the 19 million. That's the net total over the last 5 years. But here's how it happened over the course of those 5 years. There was a loss in 2015. Most of it's been recognized, but we still have a little piece of that left. 2016 was almost exactly as expected, so that really didn't change anything. There was a gain in 2017. We've recognized most of it, but there's still some left to recognize. 2018 was a bad year. There was a loss that year, over $20 million loss, but we've recognized almost half of it now. 2019 and 2020 were both good years, and we still have a lot left to recognize, which is why we're left with $19 million in unrecognized gains. And the net total for those, the prior years, is a significant gain. So the plan's been doing really well. There's a similar picture for the separation allowance, but the amounts are a lot smaller. So the key risks for the plans, investment returns lower than expected, didn't happen in the last couple of years, and it's not happening yet this year, but that's more of a long-term risk. And that's, when we look at the assumptions, it's always long-term. Investment volatility is a risk, but it's something that we have ways of dealing with. We have the asset smoothing we talked about, and anytime there's a gain or a loss, it's amortized. It's not paid immediately. Salaries higher than expected. Plan maturity, meaning, as the plan becomes more and more inactive versus active, that poses some risk for the plan because it's hard to recover when the market does go down. Early retirements are also a risk, especially for the separation allowance. And I think we've talked about this in the past, but let's just say, for example, we expect people to retire at age 59. Well, that's 3 years of payments from the separation allowance. What if they start going out at age 56? And I'm making these numbers up just for the purpose of the example. Well, that's twice as many years. So that is a risk there. It's not as much of a risk for the WSPORS plan because that's a lifetime benefit. So you're adding a few more years onto the lifetime. Still was a risk, but not as much. So the last thing I want to go over with you, which is my favorite part and the most interesting, is what's the 20-year outlook, starting from where we are now. So there's two pieces to the outlook, and there's one for each plan. So there's really 4 graphs coming up. The first one is what I call funding progress. So funding progress we measure in 2 ways. Starting with 2021, here's the 81% funded we talked about, and that's on the smooth asset basis. And how is that going to change? Well, it's going to improve dramatically to the point where we're almost fully funded in a short amount of time. Here's the unfunded liability. That's the other way to look at funding progress. Over 40 million, but also that improves dramatically down to just 10 million in the next 5 years. That is entirely a function of the last 2 years of investment gains. What we're building into this forecast is no gains or losses going forward. It is not going to look like this because it changes every year. And that's why we do the valuation every year. But this is just a general trend of where are we going. And of course, it looks really, really good. As that unfunded liability comes down, the cost comes down. And that's what we see on the next graph. So this is same time period. This is the fiscal year. So when we do the valuation for 2021, which is the one we're talking about now, that actually goes into the budget for fiscal year 2023. Ends to June 30th from now. And so we split this into the pieces. I talked about the normal cost earlier. So the future contributions, this normal cost decreases to the point where it's almost zero, because at that point in time, 20 years from now, there just won't be many officers left in the plan. The amortization payment is a big chunk of it right now because we're still dealing with a $41 million unfunded liability. But as that decreases, as we just saw in the last graph, so does the payment, to the point where that's gone after 15 years. There's the LOB, the limited obligation bond, that was issued some time ago, I forget the exact year, 2013.
2013.
Okay, good, that's what I was going to say. That is done, 2038. So, a few years ago, we looked at this, those purple bars went all the way out. Now it's stopping a few years from the end to where, if everything happens as expected, and again, it changes every year, and we have to review the assumptions, but where we are right now, that cost goes way, way down. Now, before we look at the same 2 graphs for the separation plan, it's helpful to look at what we expect of the planned population. So this is going back to 2014 when the plan was closed, and it goes out to 2044 or 2045 actually. So it's a 30-year projection. This is what's actually happened. When the plan was closed, we had the same officers were in each plan. This is the active employees only. And then what happens is the blue bars started to decrease because it's closed plan. And so that's what's actually happened from well over 500 down to less or a little over 300 now. So a pretty steep drop just in the past 7 years. Everybody goes into the separation plan. So that's kind of, going up and down over the years, but generally has decreased because the size of the workforce there has decreased in those years. Wherever we are right now, we just expect that to stay level. We know it's not going to stay exactly level, but for comparison's sake, that it's helpful to look at this. So if the number of officers stays the same from now until 2045, the proportion that are still going to be in Whispers drops down to, again, almost nothing because everybody's going to retire. So that helps thinking about, how the projections are different from each other. So the very last part here is the separation allowance outlook. Same type of pattern, but not as dramatic of a drop in the unfunded liability or as dramatic of an increase in the funding percentage, simply because we're starting at a lower point. We're starting at 40% versus 80%. So it takes longer, but definitely moving in the right direction. The point where this one's also going to be fully funded, just based on a best estimate forecast. The cost is going to come down somewhat as that unfunded liability decreases, but because the decrease isn't as steep, the cost doesn't go down as much. So the red bars are the amortization payments, the blue bars are the normal cost, which we expect to change over time and generally increase. There's a little bit of noise out here just because it's a function of demographics. But the total percent of pay cost is relevant here because this is not a closed group. And the reason we show that line in the graph is because visually it's just a way to look at that at this in today's dollars. So in what's $2 million worth in 2037? I don't know because there's inflation between now and then, but in today's dollars, it's really declining. So that's a good sign also. And so, in conclusion, the investment gains have been the most significant factor influencing plan costs. And that's usually what it is, whether it's gains or losses. The impact of the investments on the plan funding generally outweighs anything else that happens. I mean, we go through a lot of effort to make sure we have the rates of retirement right and the rates of salary increases and life expectancies, but the investment performance really outweighs that. Costs are about the same as the prior year, and that's a function of deferring a lot of that gain. The salaries were higher than expected, and 2020 was unusual, so we'll see what happens going forward. But the funding is expected to improve, as we just looked at, over the next 5 to 6 years, with the cost steadily decreasing. And, of course, I can't say this enough times, but it will be affected by actual experience. We've seen this in the past. We're seeing it right now, but the outlook can change an awful lot just in 1 or 2 years. Full assumption review, as I mentioned, that's coming up next year. So when I do this meeting for you next year, next May, it will be longer because we're going to go over all this and we're going to go over each one of the assumptions. So, we say review and possible update because we have to have enough evidence to say, yes, a change is warranted. Usually if you do this every 5 years, which we do, there are usually small adjustments to each assumption. And I believe that's all I have for you today, and unless there are other questions.
I got one question, and David Rose, this is Mike Cardwell, maybe he'll help with this. Are you guys considering this new bill with Mickey Hutchins giving credible service or being able to buy credible service with a advanced law enforcement certificate? Is that something that, David, is that still on the table, looking positive to go through?
I don't know about looking positive about that.
You're breaking up,
It is
David.
in the Senate, but in Senate, but I'm
I don't
cautious
know.
on that one. I think I froze up. Can you hear?
There, we got you now, David.
I think I froze.
It's still in committee, is that right, Mike? Or do you know?
Yeah, it's still a committee, but last I heard it was set to go through. I can tell you now that's going to give another couple of years of credible service to a lot of officers that are close to retirement on top of the retirements that we have projected for this year. Because I know several have talked that they'll immediately try to buy that service. They've used just the other military and other ways to calculate that. But the way it looks now, it looks like it could be applied on top of other bulk service time. So that may increase. Is that a concern if we've got we're talking about the 25-year officers now potentially would be able to retire. And I know several of them are looking at that, but is that something we need to be concerned about if that goes through with the funding on this?
We would need to, let me say this. First of all, I don't think we know who will buy back that time. So it's really hard to, I've got a list and I know there are tons of people eligible for it, but I think it's really hard to model when we don't know who will buy back their time.
Right.
Yeah, I got
One other thing about that, and tell me if I'm wrong, but if somebody elects to take that option, they can either buy that back in the state retirement system or in the city, but they can't do both. Is that correct?
That was my understanding, but it could be on top of purchasing other credible service. So you technically could do it in one plan and one in the other.
We would have to actually go in, even though we follow the state, or we mirror, I should say, for the most part, except a few exceptions, the state plan. But we would have to go in and revise city code for that to be an eligible factor of whispers.
Okay.
So
That's not something
so it's almost like we need to wait till the state to see what the state does, and then have a discussion that says, do we want to do this for whispers as well?
Okay, I got you.
Yeah.
And just my 2 cents on that is, as the actuary, it would depend on, as far as how much is going to impact the funding, it would depend on what officers have to do to purchase the service, because there are a lot of different ways that can be accomplished. I've seen some plans where they just have to pay what they would have contributed, which is going to be a loss for the plan because they don't have to pay what the city would have contributed. And I've seen other plans where the officer is required to pay the full actuarial cost, meaning that's pretty expensive. Each year would cost quite a bit of money. In that case, it's not as much of a loss for the plan. It adds some risk, but it's technically breaking even.
That makes sense.
Can you hear me? Mike, can you hear me now?
Yeah, I got you, Dave.
Okay, I got signed back on. Sorry about that. But this would cover the actuarial costs up to 4 years. The officer would be responsible for the actuarial costs. It would, for lack of better analogy, it would mirror the service time purchases.
And that's the way the military buyback is right now, isn't it, Dave? Is that right?
Yes, it would mirror that.
I got you.
Lisa, can you forward this report to us?
Yes, I will be glad to.
That'd be great. I appreciate it.
I will forward
We get questions from time to time. That's really good.
Oh, absolutely. I'll
For us
forward
to
the
follow up there.
presentation. I can also forward you the actual reports themselves if you would like them. Okay, I'll do both.
Yeah, this summary would be great.
The summary is probably what you want to use, but I'll forward you the other 2 reports just so you have
Okay,
them.
very well. Thank you.
You're welcome.
Okay, I don't know if there are other questions, but I'd be glad to answer them now, or if you have a question later, you can always send it to Lisa and I'll get you an answer.
We look forward to your big report next year.
Yes.
Thank you.
Okay, thank you, Mr. Stump. Do we have any other business for the regular session? Okay, is there a motion to close the regular meeting and go into our closed session?
Motion, Cardwell. Or second, Cardwell.
All in favor? And Lisa, are you going to do a roll call for that one again too, or?
I don't think I need to do a roll call for that one. No, you're good. We're just in closed session now.
All right, so we're in closed
Have a
session.
good Memorial Day. Thank you.
Bye.
Bye, Greg.
Bye.